Hi everybody, and welcome back to Chapter 4, Video 5. Here we're going to take a look at a classified balance sheet. And all a classified balance sheet is simply making some logical subdivisions of assets, liabilities, and equity. So into current assets, non-current assets, etc. Very easy, really. Current assets, as we've talked about, are expected to come due, or collected or owed within the longer of 1 year or the company's normal operating cycle. Almost all operating cycles are less than 1 year, so most companies use 1 year period in deciding that division. Okay, so here is a classified balance sheet. And as you see, here is current assets, long-term investments, sometimes called fixed or long-term investments, planned assets, sometimes called fixed assets, and intangible assets. On the other side of the balance sheet, we have our current liabilities and long-term liabilities, and then we pretty much keep equity in its normal divisions. Okay, current assets. We know what those are by now, and some examples. Normally, we're going to use cash, short-term investments or cash equivalents, accounts receivable, short-term notes receivable, inventory, prepaid expenses. Those are all current assets. Long-term investments are expected to be held for more than 1 year or the operating cycle. Often that's notes receivable or investments in stocks and bonds expected to be held for the longer of 1 year of the operating cycle. Planned assets, these are tangible, meaning they have physical substance and we can touch them physically. And we use those long-lived assets to produce our products and services. Some examples would be equipment, machinery, building, and land, although we do not depreciate land. I'll say it at least once. And we use those to sell our products and services, often referred to as PP&E, property, plant, and equipment, or fixed assets, as I mentioned. Intangibles are long-term assets that benefit business operation, but they lack physical substance or forms. Example, patents, trademarks, copyrights, franchises, and goodwill. Current liabilities are expected to be paid within a year or the operating cycle, and examples are going to include accounts payable, wages payable, taxes payable, interest payable, and unearned revenue. I should point out that our long-term liabilities here, the notes payable, might have a portion that's current and might have a portion that's long-term. So we would show that same note, usually to a bank that we borrow money from. We'll show that in two places on the balance sheet. Others might be mortgage payable, bonds payable, or other lease obligations. Equity is the owner's claim on assets, where liabilities are outsiders' claims on those assets. For a corporation, we're going to report it's going to be reported in retained earnings and the common stock account. Equity is not separated into current and non-current categories. All right, let's take a look at the profit margin and the current ratio. In this case, the profit margin, when it's left unmodified, like operating profit margin or gross profit margin, that means net profit divided by net sales, as it's shown here. Net income divided by net sales. And here, they're showing some examples of that for Visa and MasterCard. It's showing its profit margin, 53% for the current year, which has improved. And so has MasterCard. So that's one of the key metrics that we use to evaluate a business. How much do they hold on to from every net sales dollar that they make? Okay, current ratio. Current ratio is current assets divided by current liabilities. Just that easy. And it's a measure of liquidity. It tells you how easily we can pay off our current liabilities with our current assets. We want to have that be a little bit, for sure, greater than 1. But at least, normally we would say about 3 to 1 would be a nice benchmark for that. In the case of Costco and Walmart here, both of them fall below that benchmark, and probably reflect the difficulties that brick and mortar retailers are having these days. All right, alternatives in accounting for prepaids. I'm not going to go through this section with you. I think that this is a little overkill for an MBA program. I will not test you on this as well, but you're welcome to go through this section of the PowerPoint if you're so interested and look at how we alternatively account for revenues and expenses. And I will not go through this appendix as well. I'm preparing the worksheet, and I'm a real fan of worksheets. Don't get me wrong, Excel is very important, but I think that it is not a required report. So again, a little over the top, I think, for an MBA course. Reversing entries, I've already gone through that. Again, I will not test you on reversing entries. And that ends our Chapter 3 videos. And when we come back, we'll take a look at Chapter 5. I will include the Chapter 4 PowerPoint in these supplemental files, should you want to look at that for your own edification. Until then, bye for now.